Getting on to the presentation, what we really probably came here for. In 2009, this is what it looked like. We made our first acquisition, GR4 office. It held actually 5 buildings. We had about 20 investors. We had 1.6 million of equity for that deal. March 2016, we have 26 sub-LLCs that we own 100% of, a total of 37 buildings, over 200 investors, 56 million of equity, 2.3 million square feet, and 170 plus tenants and growing. And we own all different kinds of assets. Total equity since inception, you could see it by the end of 2009, we'd had about 4.3 million. And this is cumulative, so each year we've been adding, and this is a combined number of the equity raised to close the deal and the share price increases we've had along the way. So we call equity, we often refer to it as our book value, and we say that's basically $58,000 a share now times 977 shares or something, close to 1,000 shares. It's starting to look a bit like a hockey stick, and if you look at our square footage under management, it's the same thing. And if you look at the orange, this orange represents office space and mostly general office space that we've added. And general office space is far more management intensive than this industrial space that we added. Was when we started, you could buy medical office and some other retail type properties relatively inexpensively when the world was coming to an end in Michigan and nobody wanted to buy anything. Over time, those dried up. Medical office was the first thing to rebound, and we really couldn't find any medical office that we could buy at an acceptable level. So then we started getting into industrial, and we hit a sweet spot in industrial, and the same thing happened. Nobody wanted to touch industrial. They just couldn't figure out when it would come back. Well, industrial's all dried up too. The reason I like this so much and the reason why it's so exciting is because all these properties we've purchased will now sell for a lot more than we paid for them if we were to sell them today. The problem with selling them is then what do we do with the money and where would we put it? I think the next wave is general office. Nobody's building any of it. People need offices. As businesses recover, they're going to continue to expand. We're seeing it all over the place. This is my favorite slide. What we have here is something that shows you the relationship between the investors, PF3, all the way down to our tenants. And if you follow it, the investors use their money to buy shares in PF3. That's simple enough. We then take the money from PF3 and we combine it with some debt financing from the bank, and we use that money to buy properties which are held in the sub-LLC. Okay? So every property is held in some limited liability company by itself. All those companies are 100% owned by PF3. Then what happens is our tenants pay rent back to our sub-entities, and from there, those entities pay the operating expenses. Operating expenses consist of taxes, insurance, sometimes utilities when the tenants don't pay those, management fees, building engineer salaries. Once we pay those operating expenses, we make mortgage payments too. So we pay the debt service from those entities. After we've made all those payments, we usually have a little cash left over, and that money flows back up into PF3. And from there, we establish reserves. Okay, I'm always talking about reserves. That's our cash on hand. We want to build those reserves because it protects our assets. Those reserves are there to pay capital expenditures. Capital expenditures are just big expense items that aren't in the normal course of operations. Maintenance, upkeep of buildings is paid down here in operating expenses. A new roof, a new mechanical system, a new parking lot, that's a capital expenditure, and that's why we need the reserves to make sure that we have that money, or if we have a tenant move out and we need to put a new tenant in and they want a few $100,000 of build-out expense, we want to have that money on hand so that we can do it, because that's what attracts the tenants. After that, after we paid all that stuff, we've got cash flow, and that's what we're distributing out to the investors. One other thing we're doing is we're taking the reserves that we don't think we're going to need today, and we're investing those reserves in various ways to get a return on them, which increases the overall cash flow, which allows us to raise the share price, and raising the share price means we distribute more money. This sheet, the run rate overview, you get this sheet sent to you in virtually every packet we send out. This is a simplified version, but this is the most important sheet that we look at on a daily basis as far as I'm concerned, and it demonstrates the power of what we've built. We do have this $56.6 million of equity, but the most important thing is we have $12,200,000 of net operating income. We only have about $6 million in mortgage payments. Now that sounds like a lot, $6 million, but it's less than half of our net operating incomes. We could literally lose close to half of our net operating income and still be able to carry our entire portfolio. That is powerful. That is something that you don't see with people that own real estate. Usually they're higher levered, and the banks will tell you that they want to see at least a 1.2 times debt coverage ratio. If we had a 1.2 times debt coverage ratio, this next number, cash flow, would be $1.2 million. Not $6.2 million, it would be $1.2 million. We literally have an extra $4 million above and beyond what a bank's underwriting or requirement would be, which I think means we've built a substantial foundation from which we can build upon. The cash return on equity is running 11%. That's just the 6.2 million divided by the 56 million. We have to take reserves out of that, so that's not really a pure return number, but it's what it's running. Our principal pay down component, it's important to understand that this 2.5 million roughly, that's included in this number. So we're making principal and interest payments, and this is the principal portion. If we got to a point where we couldn't distribute and all we could do was carry our debt, we'd still be making a 4.3% return on our money because we're reducing debt. So we've added it up and said, well, we're running around a 15% total return on equity. Again, that's not exact because we have some reserves that we're holding back, which will reduce that number by about 3.5% to around 12. But at the same time, properties aren't exactly worth what we paid for them. We think they're worth a little more, so that number could be substantially higher. We just don't put it out there because it's speculative and we don't really know what it's going to be. Can we get 5% appreciation on our properties, 10? We certainly know some of them have sold for 30% higher, and we've had some substantial gains. Our leverage is roughly 55%. That's just this number and this number added together. Again, if we had an appraisal of all our properties, I think that would drop to around 45% to maybe 50% because I think our properties would appraise for a lot more than we've got them on our books for. 4.2 million, that represents the 7.5% we're distributing, and this number is based on the May distribution after we close the AAA building at the end of March. This right here, 4.25 out of the 6.2 represents about 68% of our free cash flow. So we're currently distributing 68% of cash flow. That's pretty conservative. Most people will pay out 95% or all of it because they want to look good and they want you to see this high yield because it'll make it easier for them to raise money. But that's why I'm taking the time to educate you, because I don't want you to fall into that trap, because that's what I did when I started investing and I lost all that money. And that's how I learned to be conservative in nature and to keep a reserve back. We want this ratio here to hover right around 70%. If it's 68, that's a little better. If we get it up over 71, 72, we might pause it there and wait. And the effect of this is, if we were to arbitrarily say share prices are not 58,000, they're now going to be 59,000. We've added $1,000 to every share overnight. We have roughly 1,000 shares. So that's about $1 million of additional equity that we're putting essentially on our books. So this 56.6 would go to 57.6, and all of a sudden this number 4.25 would go up by 75,000 because we'd have to distribute $75,000 on that extra $1 million, right? And that means that our reserve build of roughly $2 million would go down by $75,000. So people ask, how do we figure out what the share value should be? The answer is we raise it as quickly as we can while trying to maintain what we feel are very conservative ratios. We have roughly $5.1 million cash on hand, so behind every share that's 58,000, you have roughly $5,000 behind it. So going through it one more time, the investors buy shares. We purchase real estate along with some bank debt. The tenants pay the rent to the sub-LLCs. We pay the operating expenses. Tenants pay the rent, less the operating expenses equals that net operating income number of $12.2 million. We pay our debt service of roughly $6 million. Out of that, our principal paydown component is a positive $2.5 million. That's what we're reducing debt by. The net cash flow that's left over flows up. That's the $6.2 million. We establish reserves, which on an annual basis is roughly $2 million. And then the cash flow of roughly $4.2 million, or $350,000 a month in May, which brings a tear to my eye because that's a massive number, much larger than anything I ever thought I'd be distributing, and hopefully a fraction of one day what we'll be sending out. And then of course we're investing the excess reserves and we're using the reserves for capital expenditures. So obviously this is going to grow, right? Because we're taking on more capital, and so we're distributing more in that capital and we're buying more assets. In addition to that though, as we raise the share prices, hopefully with any luck at all, and I think we'll have no problem with this, by year end we'll be at $60,000 a share. So what that means is if you had bought in at $50,000 a share, you're no longer getting 7.5%, you're now getting 9%, because 7.5% on $60,000 is 9% on $50,000. So you are getting rewarded for being in early, and we have had some bonus or catch-up distributions over the years as well as we've sold assets, which has benefited members as well. Very quickly, on the portfolio overview, there's no way to go asset by asset. So what we've done is we've grouped them into what we call Sunny and 75, exceeding expectations, and then some challenges that we're dealing with. But our Sunny and 75 assets we classify as basically cash flowing at what we represented, perhaps a little bit better. There's some value in these buildings because cap rates have compressed from when we bought them. So on a sale basis, some of these properties are going to be worth substantially more than we bought them for. There may be a few others that aren't quite worth what we bought them for. That's hard to tell. But I certainly think the winners far outweigh the losers. We keep track of this in our office. We keep a run rate sheet internally to try and gauge what we could sell an asset for so that we can evaluate what our current equity in that building is returning. Okay, there's a difference between the original equity. So if we have original equity in a building of say $1 million and it's generating $100,000 in free cash flow, that's 10%, right? Well, if we could sell that building and we could get $2 million out of it, then our current equity in that building of $2 million is only generating 5% in cash flow, right? Because it's the same $100,000. So in those circumstances, we would consider selling that asset, taking that money, and putting that $2 million into something where we can get 10%, and then we've doubled the cash flow from $100,000 to $200,000. So these are our Sunny and 75 properties, and coincidentally it represents about 75% of the portfolio. The challenges. I won't get into the whole story, but essentially we bought this property down in Tennessee, in Memphis, in an area that we were told was kind of on the rebound and coming back, and it looked like it could be, and they just knocked down this old defunct mall, and there was talk of development in the area. The company on the left here, called New Horizons, they're a computer learning center, they sold us the building and they signed a 10-year lease back on the building. And we thought, well, what do we have to lose? Because we assumed debt on the building that they had in place, and that debt would be fully paid off after 10 years. So we thought, well, we'll cash flow nicely for 10 years, and then we'll own the building free and clear. What could possibly go wrong? Well, just about everything has gone wrong. Promptly, about 18 months after we closed, New Horizons defaulted on their lease, and they claimed that they lost a contract with some government thing or whatever. We had to cut their rent just to keep them in the building. I negotiated with the life insurance company that holds the loan. Fortunately, it's non-recourse, so we were in a good bargaining position with that lender, and we got them to term the loan out over a longer period of time. This creates the problem of when the lease is up, the building's not going to be owned free and clear, but it's still de-levering very quickly, and we're still cash flowing this property slightly.